I'm Greg Brown for Newsmax TV Money. We're on the line with Paul Justice at Morningstar. He's their strategist for exchange-traded funds known as ETFs. Hello, Paul.
Hello, how are you?
I'm fine. How are you?
Great.
What are some of the specific sectors that you recommend now?
Well, first we always recommend that people have a broadly diversified portfolio to start out with, and you can always gain that with either a SPDR, a broad market S&P fund, or for instance a Vanguard Total Stock Market ETF, which the ticker on that is VTI. But if you want to broaden out from this core approach and begin venturing into some sectors, some of the things that we've been looking at recently are some of the areas that have actually been some of the stronger performers over the course of the last year. Namely, we have some exposure to energy ETFs. Right now, we're owners in our ETF investor newsletter portfolio, the hands-on portfolio of the iShares Dow Jones U.S. Oil and Gas ETF, and the ticker on that is IEO. And the reason why we like that is because we're bullish on the prospects of some of the U.S. exploration and production companies. Now, granted, this has sold off here over the last couple of weeks as oil and gas prices have come down quite a bit, but we think that it still remains compelling value today, more so than it was even just a month ago.
We talked before, and you mentioned that that you tend to look at things from a value perspective. I wanted to ask is it too late, even from that perspective, to buy into commodity funds?
I don't think so, and especially if you're thinking about being a longer-term holder. If you're looking at commodity funds, if you want to get direct commodity exposure, you can always go with the iPath Dow Jones AIG Commodity Index. The ticker on that is DJP, and we think that gives you broad exposure to a basket of commodities. Whereas, if oil runs down, but some of the other commodities hold up, you're going to have some good diversification benefits from that particular fund. Now, like I was saying before, we currently own both of that. We both own DJP and IEO, which I previously mentioned. But if you're afraid that oil stocks are going to be coming down a bit, you don't want to own IEO, or maybe you think that there has been price dislocation, as we do, that the oil and gas stocks themselves are undervalued while oil may in fact be coming down. A lot of the oil companies in our valuation models, we're forecasting about an $85 price over the long term, and current market's still sitting at about $120. So if you wanted to get exposure to these stocks, you could buy IEO, but then using ETFs, you could also buy something like the Macro Shares $100 oil down, DOY is the ticker on that. So you'll have some diversification by hedging your bet against oil. Oil could go down while these stocks could either stabilize or potentially go up. So that's just one strategy that ETFs have now offered investors that really wasn't available to individual investors on the retail level up until just a couple of years ago.
Of course. Tell me what you think about currency ETFs, considering the movements of the U.S. dollar these days.
Well, with currency, the trouble with currency is it's not always mean reverting. These things can tend to move directionally for long periods of time, and it's hard to predict what a macro economy is going to do given different fiscal and monetary policies across the globe. But they can be useful as ETFs for investors who have a high conviction idea if they wanted exposure to some particular currency. And the proliferation of currency ETFs is really giving you a chance to play many markets.
Are there any ETFs investors should avoid completely at this point?
Well, to say that you need to avoid them completely takes a pretty high conviction thesis. Of course, you don't want to replicate something. There are all types of ETFs out there. Some are long focused, some are short focused. So you don't want to own both of those at the exact same time. It wouldn't make much sense to do so. Just to give you an example of some of the things that we've recently pared back on, we were owners of some ETFs that had taken a beating in the market fairly, over the course of the last year, such as the iShares Dow Jones U.S. Home Construction ETF. Ticker on that is ITB. We also sold out of our KBW Bank ETF. The ticker on that's KBE. And the reason being is just simply it's the risk factors within those sectors had increased a bit too much for what our our overallocation of those sectors was at the time. So we've recently pared back in those, and granted, because we do own some core holdings, some broad indexes, it doesn't mean we have zero exposure to home builders or financial stocks. It just means that we're no longer heavily overweighted to those sectors.
Of course. We've been talking with Paul Justice, strategist for Morningstar, about exchange-traded funds. Thanks, Paul, for your time.
Great. Thanks, Greg.
I'm Greg Brown for Newsmax TV Money.